Okay, supply and demand zones represent a huge imbalance between selling orders and buying orders at certain price levels. This zone represents the movement of smart money. Okay, these levels are created after a huge number of orders are entered into the banking system, thus creating a significant imbalance between buying and selling orders. A massive wave of orders can be created by institutional fund firms, central bank, public bank, etc. Individual traders do not generally have the buying power to make such purchase and influence the market in this dramatic way. After the huge imbalance being between buying and selling occurs, as the massive wave of order is placed, the price runs away from the original level very fast and end up leaving many unfilled orders behind at the supply level or demand level. The large institutions then wait for the expectation that their orders will be filled once the price gets back in the zone. This zone is what we refer to as order blocks. Okay, so now when you see what's wrong? Let me see my internet connection. So when you see massive orders, okay, orders are yet to join us. Let me still remind them. Anybody, you don't have to bother yourself. Anybody that is here, okay, okay. Let's just because of time. Though I'm going to record this, it's also going to be available on YouTube. So let's just forge ahead. Let this just load up. Okay, so once you have the massive imbalance in price can always come back to fill up those orders, okay, which is demand or supply level. So institutions target those levels of impulsive buying and selling, especially when it is against the major trend. Okay, when we have those impulsive buying and selling against the major trend, buying and institutions can always target those levels as potential take profit levels. Okay, so let this open up so that I can show you guys what I'm talking about. Network is really slow. Let me connect to my other phone. Internet is really bad today. Okay. Welcome everyone. Welcome. Mark Martins. Welcome. Ibekwe Stephen. Anastasia Only. I don't really know you guys in person. Possibly you can also send a message so that I can have your number saved on my phones. And then yeah. So let me resume sharing. Okay, so I know I don't know if each of you joined from the day one. If you joined from the day one, just write day one. Okay, if you joined us from the day one, just write day one. If you joined us from the very first day, just write day one in the comment section. Okay, Sunny has been here from day one. Yeah, any other person from day one? Who again? Who again? Okay, so I've been following you from X space. Oh wow, that's nice. That's nice. Yeah, the recording from day one will be available on my YouTube channel from tomorrow. Okay, I joined on day two. Okay, that's nice. Okay, so you have the day one. I recorded all the sections. So you have the day one available. I'll start uploading them from tomorrow, I guess. So the day one and day two is ready. So I will start uploading them at intervals. All right, so you can take your time, go through the sections, and yeah, you will definitely learn something. Okay, definitely learn something. Even me that I'm teaching you, I'm also refreshing my memories. It's very, very nice that you also refresh your memory as a forex trader. All right, so we're actually looking out for those areas where we can find impulsive buying pressure. Okay, impulsive buying pressure, like I said, is where we have the market push out strongly out of a particular level. Okay, example is let me use GBP USD as an example. Okay, this is an impulsive buying pressure. This is also an impulsive selling pressure. But we had another impulsive buying pressure that countered the impulsive selling pressure. Okay. Like I said a few minutes ago, when we have an impulsive selling pressure, when it's not against the trend, institution and hedge fund, they will always look to take profits at the counter. Okay. They will always want to drive price back into that level. And now this is also a candlestick, a pattern that I love, a pattern recognition I love very, very much. Whenever I see an impulsive move like this to the downside, I will always want to see a follow through move. Okay, the follow through move is a move, is a candlestick that is in that particular direction. If I don't see that follow through move, and then I see the opposite direction candle print out, is most likely that that is just a fake out. Okay, now you see it here. This is an impulsive selling pressure. I always want to see a follow through move of that selling pressure by price closing below. Okay, if I don't see that follow through move, I can take a buy from this point. Okay, this is also it. Impulsive move to the downside, you should have a follow through move. But when you don't see that follow through move, you know that that impulsive move is just a fake out, and then you have price delivered to the upside. Okay, so impulsive move like this, the next candle should be the follow through move. Okay, when you have the next candle, and then you can have price continue in that direction. Okay, see here also you have the impulsive move. Without a follow through move, you can see price will deliver to the upside. Okay, so here we have the impulsive, no follow through, and then you can see the price delivery. Okay, so these are important things that you should have. Okay, but these things actually come by experience. Okay, it's not something that you will learn overnight. Okay, it comes through experiencing the market unfold in your very before. Okay, so like we said, uh hedge funds, institution move, bank, central bank are what makes up those other blocks. Okay, when price move out of a particular level impulsively, okay, they leave behind what we call an order block. Okay, these order blocks are where orders are being piled up. Okay, buying and selling orders are being piled up. Okay, so they can be used as reference points for bullish and bearish presence. Okay, so a bullish order block can be referred to as the last bearish candle before a bullish impulsive move or imbalance candle. Also, in identifying a bullish order block, a trader can mark out about 2 to 3 candle which makes up that make up the order block. Okay, so now remember we said an order block is a candle, the last bearish candle, okay, before an impulsive move that left what an imbalance. So for you to identify an order block, now these are things you need to understand. Okay, now for you to identify an order block, the psychology behind identifying an order block simply states that for you to identify a bullish order block, you must see what a bullish order block can be referred to as the last bearish candle before a bullish impulsive move, okay, or imbalance candle. Now let's this same analogy we have here, let's look for it in the in price. Okay, so now they say what an order block for a bullish order block is the last bearish candle. So now the last bearish candle before an impulsive move that left an imbalance. Imbalance is just space. Okay, how do you calculate imbalance or how do you get imbalance? Now you have your first candlestick formation here with the wick.
Please, boss, come again. I'm jotting down. Sorry.
Okay, from where did you stop?
Bullish order block
Okay,
is the last impulsive,
yeah, a
last
bullish order
bearish
block
candle.
is the last bearish candle before an impulsive move or an imbalance. Okay, a bullish order block is the last bearish candle before an impulsive move or an imbalance. Okay, or most likely the impulsive move should create an imbalance. Okay, so how do you calculate an imbalance? Now, this is the first candle formation. This is the second candle formation from here. The second candle formation down to this place. It has its own wick. Has its own wick, and then it has its own body. Okay, and then the third candle formation opens here. Now, it's in this third candle formation now that you will know if we are going to have an imbalance or not. Okay, now this third candle, the wicks, okay, the wicks should not cut across the equilibrium of this middle candle here. I will also show you on price chart. Now, these wicks should not break like this. It should not touch this other wick. Okay, if these two wicks come in contact with each other, there is no imbalance here. Okay, price was filled up efficiently. Okay, but if we have something like this, okay, if we have something like this, now we can mark out the high of this or the low of this previous candlestick with the low of this candlestick here, and then we have our imbalance. Okay, this is an imbalance. All right, so now let's look for it in price. Okay, so it's very simple. I'm just looking for a very clear imbalance for you guys here. All right, so this is an imbalance here. This candlestick, the first one, this is the second one here. The same analogy I gave you here. The first one, the wick, the second body should have space in between, and then the third one should have wick, but should not cover the equilibrium of the price. Okay, so if I'm using this here to calculate it, okay, so now this is the middle point. This is the middle point here. It should not close below the middle point here. Okay, so that when next price comes back, you can see here it held here in the midpoint, held here as what? Imbalance to deliver price to the upside. Okay, so these are where you see potential support and resistance level at this imbalance point here. Okay, so you take the candle, okay, but in this case is the last bearish candle before the bullish move. But when it has an impulse, it has an imbalance there, you can take the midpoint of the imbalance and then have a good delivery. Okay, you can have a good delivery. Let's see another example in price. Okay, let's see another example in price. Okay, let's see if price covered the midpoint. This is the low here. This is the high here. You can see the next candle formation came to the midpoint. So this was the imbalance was already filled up. Okay, but there's still small imbalance here, but price did not really respect it. Do you understand why? Because it has already tampered with 50% of the imbalance. Okay, so it's not really relevant anymore. All right, so let's look for relevant imbalance. Okay, let's look out for this one and then see what happened here. Okay, so let's see, mark out from the low. This is for the imbalance candle, yeah. This is for the imbalance candle. You can see here we had about 50%, but this time around price actually rallied and closed below it. Okay, rallied and closed below it. It's not all the imbalance that will work. All right, it's not all of them that work. Remember, it's not all of them that work. All right, so there are high probability imbalance where you see price like this one now. Price hasn't come back here. Okay, these are imbalance candle. So now you have to join it with what? The last bearish candle or the last bullish candle before the upward move. So now this is the way you have your order block marked out. Okay, this is where you can mark out your order block. This is the last bullish candle before a bearish move that caused imbalance here, imbalance here. We have a couple of imbalance here, and so on and so forth. Okay, so if price comes back to this place, you can see it here. It could most likely hold for price delivery to the downside. Okay, so these are the ways you get imbalance. And then when you can see prices reacting to this level, is at this point you start waiting for candlestick confirmations that will take you to the downside once price is reacting to this imbalance level. Okay, so these are things you understand. It's not because price has gotten to imbalance then you place your buy limit. No, price will just come and liquidate you. Okay, sometimes you just come take out the high of that imbalance and then drop. Okay, just like the way it did here. But if you're patient enough, you wait for formations to show you that okay, price is willing to go to the downside. After you have this bearish closure here, you can take your trade from this area here, okay, or the open of this bearish candle. Okay, after that impulsive move, you can take your trade at the open, place your stop loss at the high of the confirmation candle, and then you can ride for a 1:2. Okay, ride for a 1:2, switch 1:2, and then you have your profit locked in. Okay, so these are the ways we actually do it. Okay, we actually lose trades also, but if you do this religiously with a sound mindset and maintaining your rules, you have a good result. Okay, so let's forge ahead. Let's see. And then identifying a it is believed that inside those candlesticks, the institution have already set a buy order, waiting for the market to retrace into that bullish order block, demand zone, and then trigger their orders. That is why before marking out an order block, the candle formed before the impulsive move is or are carefully observed or analyzed. Also, the formation of our bearish order block is the last buy candle before the bearish impulsive move, which creates, okay, remember it must create imbalance, and then when price is expected to retrace back to fill the imbalance of tapping into the order block supply zone formed, okay, and continue bearish. Okay, so that is what price must create, that gap. Okay, it must create that gap. Okay, giving us that confirmation that what it is, what an imbalance. Okay, or it is a valid demand or supply zone. Okay, so that is the way it is. It's not every last bearish candle you see that is another block. No, you must see that imbalance in price. Okay, you must see that imbalance in price. Now let's check for like here now. This was an impulsive move, created a little imbalance here, and then pushed up. Okay, created a little imbalance. When price came back to the candle, you can see it here, and then pushed back up. Okay, but let's still see the other clearer examples here. Okay, you can see here, this was the last bearish candlestick. Okay, the last bearish candlestick before this massive impulsive move that gave us imbalance here, okay, you can see. And then when next price came back, tapped into it, and then we had this confirmation. If you were to take this trade, it would be nice that you wait for what? This is a bullish engulfing pattern. So you wait for it, and then you can have your stops below, okay, and then target a 1:2 and have a good trade. Okay, though you can still have a 1:3 3.7 or whatsoever, but 1:2 ideally. Okay, so even if you were to wait for candlestick to form completely, you can still have another entry from here, and then your stops just below here, and then have a good buy. Okay, is imbalance and fair value gap the same thing? Yes. Okay, imbalance and fair value gap, they are all the same thing. Forget about, there are so many big grammars in this FX industry. Okay, there are so many big grammars. It's just for you to understand the psychology behind those big grammars, and then you'll be saved. Okay, forget about this now. They are saying ICT, SMC. Everything is still the same thing. Okay, everything is still the same thing. They're just trying to, people will just come up with a name, claim is a concept, and sell the course to individuals that are not properly guided. Okay, so I can see this guy. This guy used his sister's phone. I can see Monique Ekbo. All right, so uh, you're welcome. Okay, so let's continue. Where did we stop? Okay, so for a bearish order block, we also observe the formation of candlestick that in before that impulsive move, which at times more than one candle is marked out as the order block supply zone. Let's check this out in the chart and have a better understanding of the concept, okay, which I just explained. Okay, bullish order blocks demand candle. As you did notice in our chart above, after the price made the impulsive move, uh, the price later retraced to fill up the imbalance, tapped into the order block created before the imbalance, and then continued bullish. Okay, so price was actually going up, filled up imbalance, tapped into the order block, and then continue moving bullish. Okay, so that's a clear example of bullish order block. Okay, the same for a bearish order block. When they are being created, price will then tap into that order block and then continue going bearish. Okay, similar what we have here. We have this price expand, leaving us with this imbalance, giving us this last bearish candlestick. Okay, in this case, we're going to use this two. Okay, because it's advisable that it has wicks. Okay, because in most cases, price just come into the wicks and then uh, tap into them. If you see a candlestick like this without much wicks, it's better you use two candlesticks, one with wick and then one without wick. Okay, fill up this imbalance, tap into it, and then continue riding up. Okay, the same thing with this guy here. From here, push, give us this imbalance, tapped into it just slightly, and then pushed. Okay, there are different type of retracement. I wish we have enough time to explain the different types of retracement. Okay, we have a deep pullback and we have a just narrow pullback. Okay, just slight pullback. Okay, so let's see. I doubt we'll be able to finish this thing today. Okay, understanding the concept of order block helps traders to identify institutional supply and demand zone. Notice, however, that the number of buyers doesn't necessarily have to be more than the sellers or the other way around before demand and supply sets in. If the buyers, for instance, are few but the order are numerous, they could upset many sellers. This is often seen when the big bank and institution traders decide to trade the commodity. Okay, so it's still the same thing. Okay, it doesn't matter if buyers are 100 and sellers are 50. If buyers are buying more than what the sellers are willing to sell, it's going to create uh, an imbalance. Don't worry, the recording is going to be available. I don't know where you got lost. I'm trying to beat time, and this system also, the battery is low. I have about 25%. Yeah, so so Fibonacci. All right, Fibonacci. All right, so uh Fibonacci retracement was originated from there's a great mathematician called Leonardo Fibonacci. Okay, so he invented or he coined what we call the Fibonacci sequence. Now, this sequence is a simple mathematical arithmetic calculation whereby you add the previous number by the new number. Now 1 plus 1 equals to 2, 2 plus 1 equals to 3, 3 plus 2 equals to 5, 5 plus 3 equals to 8, and 5 plus 3 equals to 8, 8 plus 5 equals to 13, 13 plus 8 equals to 21, 21 plus 13 equals to what? 34, and so on and so forth. Okay, so that's the concept of Fibonacci sequence. Okay, it's a sequence. It's in a spiral form. Okay, so now the concept of Fibonacci retracement in financial markets was popularized by the work of Leonardo Fibonacci, an Italian mathematician in the 13th century. The key Fibonacci retracement levels 2.23.6. This level is not part of the Fibonacci sequence, but it is included as a common retracement level used by traders. It is often seen as a shallow retracement level, which I showed you. There are different type of, which I just spoke about a few minutes ago, the different type of retracement. We have deep retracement, and then we have a shallow retracement, okay, which fib are what we use in calculating those different retracement levels, okay. 38.2, this level is derived from the ratio 3 by 8, or 3 divided by 8. It is another commonly used retracement level. 50%, although not part of the Fibonacci sequence, the 50% level is widely recognized and considered significant, as it represents a halfway point between the swing high and the swing low. Okay, 61.8 derived from the ratio 8 divided by 13. This level is one of the most important Fibonacci retracement levels and is often referred to as the golden ratio. It is considered a strong retracement level. 78.6 derived from the ratio 13 divided by 21. This level is also commonly used by traders applying Fibonacci retracement. Okay, to apply Fibonacci retracement, we first identify a significant swing point, swing high, and swing low within the trend we want to analyze. The swing high is the highest point in an uptrend, and the swing low is the lowest point in a downtrend. If the price is in an uptrend, we can plot the Fibonacci from the swing low to the swing high. If the price is in a downtrend, we can plot the Fibonacci from the swing high to the swing low. The key Fibonacci retracement level act as potential support and resistance level. We look out for price retracement such as reversal or continuation around this level. The theory behind this tool is that market often retrace to portions of this previous price move before continuing in the direction of the prevailing trend. For example, in an uptrend, okay, in an uptrend, price will always come down. Now let's quickly we have just about 5 minutes, okay? We have just about 5 minutes. Now, what I just said there is, for you to use a Fibonacci, you need to get a swing high point and then a swing low point in an uptrend, okay? So let's get a clear example right here. Okay, so now this is my Fibonacci. So for you to get a Fibonacci, you come to your trading view, then you click on Fibonacci retracement. For an uptrend, you take from the low points down to the high point here. So these are my levels: 0.23, 0.38, 50, 61.8, 78.6, and 88.2. Okay, so I think they updated this. They just updated this Fibonacci too. Before, this thing was not, they were not there. Okay, so now you see from this swing high point to this swing low point, okay, you take from the low point down to the high point. How can I set Fibonacci? Is in your trading view on your MetaTrader. You just go there, copy this number that you have here, copy them. I also send them to the group. Let me take a screenshot. You copy them, and then you go there, you go to the settings, you double click on the Fibonacci, you go to the settings, and then you impute these settings. Okay, you impute this settings. This is the way it's going to look like. You can take a screenshot so that you can set yours exactly like this. Okay, you can set yours exactly like this. You can see there are other different levels, but I'm not interested in those levels. I'm just focused on this level. And then why I'm using this level here, this upper level here, is for potential take profits. Okay, so I'll be explaining those ones subsequently. I'm just trying to beat time, and then we have our analysis, and then I think I will just call the person that won the giveaway on the group, okay? Because of time. Now you can see that price actually from this low point here to this high point, price actually retraced back to the 61.8 level and found support before pushing further up. Okay, though it wasn't able to take out this high, but you can see how well the 61.8 level held price before going up. Okay, so if we are to use the same approach here, okay, from the swing low point down to this swing high point, you can see here price came back to even still the 61.8% before giving us this high point here. Okay, so these are things you need to understand about Fibonacci. Okay, you can just take your time. Okay, once you get the numbers right, you can take your time, identify a swing low point, okay, down to a swing high point, and then plot it 61.8. Okay, price reacted at 61.8 from this swing low point to this swing high, came back to 61.8. Okay, so yeah, a quick one, though we have limited time, a quick one, you can just unmute and ask your question. If time permits, we can answer the question.
Okay, from the Fibonacci retracement just draw out right now, I noticed there are horizontal lines, and the one you placed at the string high, there's still another one above it. Why are you not placing the first line? Why is it that the second line you're taking?
Okay, now you have to use from 1 down to 0. Now look at it. That this other one at the top here is not relevant. Okay, it's not if you look at where this my tool is, from 1 down to 0, you can see the point that is marking out 0. Okay, this one is an extension. It's not a retracement. It's an extension. It's a Fibonacci extension. It's not a retracement. From 0 down to 1 is retracement. This is Fibonacci extension. Oh shit.